Corey, Cassidy, it's good to see you all again. I know we've had some back and forth asking some questions around that financial plan, and we've done some research. And today, I want to focus on two core recommendations that I think work together to protect your financial plan. Because we want to address some of those risks that I've noticed, some downside risks, by protecting your income during your highest earning years and also wanted to improve your long term tax efficiency and flexibility in retirement because together these strategies do help stabilize both your short term security and your long term independence. So let's get started by talking through why it even matters. So, when we talk about things like insurance planning, at this stage of your lives, the core issue is going to be income protection. So while you have accumulated assets and maintain some insurance coverage, your most valuable financial asset today is still your future earnings power. So the income that you expect to earn over the next decade or so is what we see supporting your retirement savings. We're seeing how it supports Cassidy's business growth and will continue to support your broader family goals. Because think about this, if either one of you were to experience some premature death or a long term disability, that financial impact would not be limited to immediate expenses. It could permanently alter the trajectory of your retirement and could force some difficult trade offs. But we want to address what you have going on right now because you've done the right steps by maintaining health insurance, property insurance, some life insurance, and those employer benefits you have opted into. And Corey, specifically you, your whole life policy does provide some permanent coverage and it has some cash value accumulation there. And you using your employer benefits does help some establishment of some baseline protection there, but there are some gaps in that current strategy, right? Because when it comes down to the whole life insurance, it's not really optimized for income replacement, especially during those peak earning years. And when it comes to your employer disability benefits, they can be limited, they could be taxable, or if you end up losing your job, you may lose your insurance, right? Because there's a portability risk there. If you lose your job, your insurance doesn't go with you, it stays at that job. And on top of that, you have some time constraints because you have less time to recover if there's some financial disruption. So these gaps do increase that risk of if one single event were to occur, it could again permanently alter your retirement timeline. So what do I recommend? I do recommend that you do get some individual term life insurance and some long-term disability insurance because that term insurance is specifically designed to replace income if one of you were to pass away prematurely, and that long-term disability does replace that income if you get sick or get hurt and prevents you from working. And the cool thing about individual policies is that they are portable, meaning that you can leave one job and go to another one and keep the same insurance. So you can keep some certainty around your benefits and that contract terms. But to talk numbers here, we do recommend, based off of common practice, you 10x or you 10 times your income as your insurance coverage there. So Corey, for your example here, let's say you have 175,000 that you make every year, your annual income there, that would recommend us looking at getting around $1.75 million dollars of coverage there, 10 times the amount that you make a year. And when it comes down to disability insurance, to talk through this one as well, it's good to talk through how your income can be replaced. So I'll do a little bit more of a breakdown here because it can be a little bit more nuanced. So when it comes down to your disability insurance, then you want to take a look at a certain amount of your money being made every month. So for this example here, course, you make $175,000, you want to target about 65% of your gross income. And if you do the math on that, multiplying it by 6.5 represents 65%. It'll mean that your annual benefit would have to be around $113,750 per year. If you break this down to a monthly benefit by dividing it by 12 for the 12 months in the year, that means per month you'll get approximately $9,479. And to achieve this, your estimated premiums, estimate here, is going to be around $250 to about $350 per month combined. And I also want to be clear here that your timing on this is critical because the next 3 to 6 months represents the most optimal window to implement this coverage while you're still insurable and those premiums do remain favorable. Because statistically, your long-term disability is more likely than your premature death happening during your working years. So this insurance allows you to transfer that catastrophic risk at a known predictable cost rather than trying to absorb it directly on that balance sheet there. And that seems like a great segue to talk through your retirement recommendation. And before we start, I just wanted to point out one of your strengths here is that you do consistently contribute to a retirement account and have some sufficient income to support advanced planning strategies here. However, your retirement assets are all currently concentrated into pre-tax accounts. While this does provide some tax benefits during your working years, it does increase the likelihood of having a higher required minimum distribution, or RMD, in the future, and reduce some flexibility later in retirement. So the recommendation here is that you, Cassidy, complete a backdoor Roth IRA and want to make sure the contribution is done this year because this involves making a non-deductible contribution to a traditional IRA and then converting that amount to a Roth IRA. So this strategy does allow for you to accumulate tax-free assets even when direct Roth contributions are not permitted. And to be clear on how these steps work again, Cassidy, you're going to make a non-deductible contribution to a traditional IRA. Second thing that will happen is that contribution is then converted into a Roth IRA, and this does bring in that tax-free growth going forward. And when it comes down to Roth IRAs, you avoid something called the required minimum distribution that at age 73 for this current tax year, you have to take money out and be taxed on it. You don't have to worry about that, so you do have some flexibility to manage those taxes in retirement. And I want to be clear here that it is going to be critical on the timing for this, that we make sure that these contributions and conversions be completed before the end of the year so we don't have a lot of time to do so. We want to make sure you're on top of it. But to make sure we're clear on how much you can contribute, you have what you call catch-up contributions that you can get access to where you are able to invest to the maximum limit up to $8,000 for your IRA contributions. So we want to be clear here, you don't get access to those deductions because of this backdoor Roth. And since Cassidy's been contributing $5,000 per year already, this strategy just requires an additional $3,000 in your cash flow this year to reach that maximum contribution. So this does result in a short-term reduction in your available cash of about $3,000, but we offset that by that long-term tax growth and reduce that future tax risk. And it's important to know that, Corey, you're currently excluded from this backdoor Roth strategy due to your existing rollover IRA balances, and that pro rata rule does require Roth conversion to be taxed proportionally based on your IRA balances as of December 31st, which will reduce the effectiveness of the strategy unless those balances can be rolled into an employer plan. But that's not what we're thinking of right here. So what are the key takeaways here? Key takeaways that one, we will safeguard against downside risk, and two, enhance that long-term upside, together strengthening the foundation of your financial plan. Let me know if you have any questions. I'm here to help. Talk soon.